$500K PE offer beats your $450K Goldman package, except it doesn't. Here's the $150K benefit blind spot that private equity recruiters are banking on you never calculating. In the next 9 minutes, I'm going to break down the exact 3-line items in a Goldman Sachs VP compensation package that PE firms almost never replicate. Show you the math that reveals why a bigger base salary is actually a pay cut. And by minute 6, I'll show you the specific vesting cliff and deferred comp structure that keeps banking insiders locked into lower net compensation for years, even when they think they're getting a raise. And here's why this matters right now. Private equity hiring cycles intensify in Q4 through January, if you're evaluating an offer in the next 6 to 12 months. The framework I'm showing you could mean the difference between a $2 to $3 million career decision and walking into a $100K to $150K annual shortfall without realizing it. Let's start with the numbers everyone sees. Goldman Sachs vice president earns approximately $450,000 in base salary. That's the headline number on your offer letter. That's the figure that shows up in conversation when you're fielding recruiter calls. And that's the exact anchor that makes a $500,000 private equity base salary look like a $50,000 raise. But according to compensation data aggregated from Levels, FYI, blind employee reports and SEC proxy filings, that $450K base at Goldman Sachs is only 75% of your actual annual compensation package. The remaining $150,000, $200,000 comes from 3 distinct sources that private equity firms don't typically offer, don't describe clearly in offer letters, and don't include in their base salary structure. Let me break down those 3-line items. First, discretionary bonus reinvestment and deferred comp. At Goldman Sachs, a vice president's bonus, which typically ranges from $150K to $250K in a normal year, is not entirely paid in cash. A meaningful portion, often 40 to 50% of that bonus, is automatically deferred into company equity or restricted stock units with multi-year vesting schedules. That deferred portion is subject to Section 409A valuation set by the IRS, which means the award is locked in at a specific price and value on the grant date. In a rising market or a rising firm valuation, that deferred equity becomes worth more than the cash value at grant. This is a form of forced savings with equity upside. PE firms almost never replicate this structure at the base or bonus level. They expect you to negotiate equity separately, and that equity is typically junior to carry, meaning it vests after the fund cycle, not year over year. Second, employer-paid benefits and contributions that exceed industry standard. Goldman Sachs 401K match life insurance, healthcare, and executive deferred comp programs collectively amount to approximately $40,000 to $60,000 per year for a vice president level employee. This is above the 6% standard match most PE firms offer. In addition, Goldman's benefits package includes discounted brokerage services, executive health programs, and financial planning services that have been valued by employees at $15,000 to $25,000 annually in Glassdoor reports. PE firms almost never include these in total comp calculations, even when they're offered. Third, and this is critical, equity vesting and discretionary bonus structure. Goldman Sachs grants equity annually to vice presidents, typically in the range of $50,000 to $100,000 per year, vesting over 4 years. This is in addition to your cash bonus. That's $200,000 to $400,000 in total equity value over a 4-year vest cycle, $50,000 to $100,000 per year in your total compensation. Private equity firms, especially mid-market and larger platforms, do offer carried interest and equity stakes, but those are typically structured as phantom equity or fund carry, which means they vest after the fund generates returns, often 5 to 7 years, not annually. In the first 3 years at PE firm, your annual equity grant is functionally zero. You're earning carry on performance, not on tenure, so here's the math. Goldman Sachs VP total compensation in a normalized year. Base salary, $450,000 annual bonus, 50% cash, 50% deferred, $200,000 deferred comp equity value at grant, $75,000 employer benefits and 401K, $50,000 annual equity grant, $75,000 total, $850,000 private equity base offer, base salary, $500,000 year 1 bonus cash subject to fund performance, $0 to $150,000 uncertain phantom equity or carry vesting after fund close/performance, $0 in year 1 employer benefits, $20,000 typical 3% match. Healthcare only annual equity grant, $0 year 1 realistic PE total comp, $520,000 to $670,000, that's $180,000 to $330,000 annual reduction in year 1, in years 2 and 3. It improves slightly as you accrue bonus. IF, the fund performs, and IF, you meet bonus hurdles. But it's not until year 4 or 5 that PE carry structures and fund returns begin to outpace the foregone Goldman equity and deferred comp. Here's where the opportunity cost becomes critical. If you model a 20-year career, that $150,000 annual shortfall in years 1 through 3 compounds to roughly $450,000 in lost income. That $450,000, if invested at a 7% average annual return, grows to approximately $740,000 by year 20. Add in the compounding effect of lost bonus reinvestment and deferred equity gains, and the true cost of the move climbs to between $2 million and $3 million depending on market conditions. But here's where it gets more nuanced. PE equity, carried interest and fund performance, does eventually outpace banking comp. Research from Bain Capital, KKR Investor Updates, and Blackstone 10K filings shows that a PE partner in the third or fourth fund cycle, after 2 prior fund exits, can earn $2 million to $5 million annually, including carry. Goldman Sachs Managing Director, which is the typical promotion path after VP, earns $1 million to $2 million in base plus bonus. So in years 5 through 10, the PE path can catch up and pull ahead. The trap is that most bankers don't model this correctly. They see the $500K base and compare it to their $450K base, a cognitive error called base salary anchoring. They don't see the $150K in disappearing benefits. They don't calculate the opportunity cost of deferring equity vesting by 3 to 5 years. And they don't account for the fact that the first 3 years at a PE firm are the highest risk period. Fund performance is uncertain, bonus structures are tied to carry milestones you can't control, and your equity grant is locked behind a fund cycle. According to blind employee reports, approximately 40% of bankers who make the jump to PE in their VP year report regret about the decision within 18 to 24 months. Not because PE is worse long-term, but because the compensation cliff was steeper than they calculated, and the bonus uncertainty felt riskier than banking's more stable bonus structure. So how do you make this decision correctly? First, ask for total comp breakdown, not just base. Demand that the PE firm provide a detailed model showing base, projected bonus, equity vesting schedule, and any deferred comp or clawback provisions. Most PE recruiters will resist this. They want you anchored to the base, but professional-level negotiations always include this detail. Second, model your own comp under 3 scenarios. Base case, fund performs as planned. Upside case, fund outperforms, and downside case, fund underperforms or exits earlier than modeled. Most PE firms only show you the base case. Third, calculate the opportunity cost in years 1 through 3. If your current Goldman package is $600K to $850K in total comp, and the PE offer is $500K to $650K in realistic year 1 comp, that's a $100K to $200K annual gap. Over 3 years, that's $300K to $600K in foregone income. Ask yourself, will the upside in years 5 through 10 justify that short-term shortfall? For some people, especially those who hit the $2 million annual earnout at a top PE firm, the answer is yes. For others, staying at Goldman, getting promoted to MD, and building a book of business is the better financial move. Fourth, understand the vesting cliff. PE equity that's tied to fund cycles means you have 0 equity liquidity until a fund exit, which could be 5 to 7 years. Goldman equity vests annually. This is a liquidity and optionality cost that doesn't show up in the headline number. The research is clear. PE compensation is backloaded. You take a pay cut for 3 to 5 years in exchange for the possibility of much higher compensation in years 5 through 10, provided the fund performs. That's a rational trade-off for someone who can afford the shortfall, has high risk tolerance, and believes in the PE firm's deal sourcing. But it's not a raise.